Hello and welcome back to another video. I hope you're all doing well. Today we are going to be taking a look at the return of the 100% mortgage. We'll be looking at what it is, who it's aimed at, who's eligible, and answer the question, should you use a 100% mortgage? And finally, we'll touch on what the return of the mortgage deal means for the property market moving forward. There's a lot to go through in this one, but before we do, be sure to hit that like button, share, and of course subscribe to the channel. We are this close to hitting 500 subscribers, and it means a lot when you subscribe. So thank you to everyone who has subscribed already and any of you who subscribe after watching this video. Now, without further ado, let's get into it. So, starting with, what is the 100% mortgage? Well, a 100% mortgage is exactly that. A mortgage loan for 100% of the purchase price of a property. Normally when you buy a property, you put down anything from 5% to 25% as a deposit. 5% tends to be on the low end of what is normally used when purchasing. There are of course exceptions where people put down more, but most people most of the time are going to sit within this 5 to 25% range. Now, the reason this has made headlines recently is because 100% mortgages have actually been non-existent since the 2008 financial crisis for the most part. Now, 100% mortgages were commonplace pre-2008 financial crisis, and there were even lenders who would let you borrow more than 100%. However, once the 2008 financial crisis hit, lenders started asking for a deposit as standard, with the minimum deposit lenders would accept ranging between 5 and 10%. So for context, this means that if you're buying a property for the average asking price of £225,000, which is according to Rightmove, you would need to have anywhere from £11,250 to £22,500 just for a deposit. This doesn't take into account solicitors' fees, broker fees, and any product fees that you have to pay. Next up, how does this mortgage work and who's it for? Okay, so how does the 100% mortgage work? Well, Skipton Building Society are the ones who recently came to the market with this mortgage. And it allows you to borrow anything from 95% to 100% of the property value. The mortgage is only available to first-time buyers, and you have to be aged 21 or over. It's a 5-year fixed rate mortgage deal, which means you're locked into that specific mortgage deal and interest rate for 5 years. The interest rate on the mortgage is 5.49%, and there are 0 fees to pay. Now, it's worth noting and comparing that the average 5-year fixed rate mortgage is currently sitting at around 5%. So you're paying an extra 0.5% just for this mortgage, which may not seem like a lot, but it can add up. So if we take an example of the £255,000 house and we spread that mortgage over 25 years, it will give you a monthly payment of £1,564. If you compare that to a 5-year fixed at 5%, which as I said is average in the market at the moment, you're looking at £1,491 a month. Now, it's not a very fair comparison, obviously, because with the 5% interest, you'd be expected to put down anything from 5 to 10%, plus potentially a product fee thrown in there too. But it gives you an idea of how this 100% mortgage could stack up against other more normal mortgage deals. Okay, now moving on to who is this mortgage for? Well, as mentioned, it's for first-time buyers, but more specifically, it's aimed at renters. And the idea is to try and give renters who can't get a deposit together the chance to get a foot on the housing ladder. Okay, so moving on to who is eligible for this mortgage. Well, as I mentioned earlier, to get access to this mortgage, you have to be 1, a first-time buyer, and 2, you have to be aged 21 or over. The other important thing to note here is that all applicants will be subject to stringent affordability checks, credit scoring, and you'll have to provide proof of at least 1 year's worth of timely rental payments. Now, in terms of paying the monthly payments, it's also worth noting that the monthly minimum mortgage repayment for those approved will not be more than the average of the last 6 months of rent they have paid. For example, let's say an applicant has paid an average of £800 per month in rent over the last 6 months. This means they'll have a maximum monthly mortgage payment of £800. Okay, well this naturally brings up the next question of how much can I borrow? Well, this is where there are some differences between a more traditional mortgage and this 100% mortgage deal by Skipton. To make sure that applicants can afford the monthly payments, Skipton is capping the maximum monthly repayment at the applicant's average monthly rental costs over the last 6 months. This stipulation will determine the overall amount of money that can actually be borrowed. Here is a handy chart to give you an idea of just how much applicants could borrow. So, as you can see from the table, if you're looking to purchase the average price property according to Rightmove of £255,000, you'll need to have been paying very roughly around about £1,500 per month in rent. This now brings me on to the all-important question. What are the risks, and should you buy a home using a 100% mortgage product? Well, let's start with the risks. The main risk with this type of product is something called negative equity. This is basically where the value of the property decreases below the total mortgage loan amount. Where this becomes a problem is if you want to move and or sell the property, or if you want to remortgage at the end of your fixed term to a new lender. Because in both situations, you will have to cover the difference. So, for simple math, let's say you have a mortgage of £100,000, but the value of the home has dropped to £80,000. That means you're £20,000 short. You're £20,000 in negative equity. Now, if you decide you want to sell the property for whatever reason, in order to pay off the existing mortgage lender, you will need to cover that £20,000 shortfall. So basically, you'll need to have that £20,000 or get access to £20,000 from somewhere to pay that difference. The other important thing to consider is the interest rate. As I mentioned, traditional current interest rates on 5-year fixed term mortgages are 5%, but this product is 5.49%. So you are paying almost 0.5% extra. Now, over the course of the mortgage, that extra 0.5% can add up to be thousands, if not potentially tens of thousands of pounds difference. Okay, next up, I want to answer the question, should you use this mortgage? And my answer is 100% no. I actually think it's a terrible idea for 2 reasons. Property prices are likely, given the economic situation at the moment, going to fall. I'm not saying they'll fall by 50%, but 5, 10, 12% is very likely. So you have the negative equity risk, but 2, you have something I call genuine affordability. What do I mean by genuine affordability? There's technical affordability, which is where the mortgage lender and your mortgage advisor see on paper that you can afford the monthly repayment. But then you have what I'm calling genuine affordability, and this is slightly different. As tenants, it's not your responsibility to fix problems with the property. So although technically you may be able to afford the monthly payments, what happens if in 2 months after moving in, your boiler breaks, or your boiler breaks and your car then breaks? It's on you as the owner of the property to sort out. And in the example of a new boiler, you could be looking at thousands of pounds. Unless you have the money, i.e. the cash, you're going to have to probably get a loan or go on finance in order to pay for the boiler. So you're going to be in debt after just moving into a property. So you're basically just adding debt on top of debt. And just because you get your boiler fixed doesn't mean that your bathroom won't leak and the ceiling will come down, or that your window will get smashed or your patio door will break. You see where I'm going? I'm not trying to be deliberately negative, I'm just trying to highlight the realities of actually owning the property instead of renting the property. It's expensive. In terms of negative equity, if properties are worth less than the mortgage, that's a big issue for both the lender and the borrower. And this is where the trouble came in the 2008 financial crisis. Well guys, there we have it. I really hope you found this video useful. I've tried to give a fairly balanced view and give you the actual details of what this 100% mortgage product is all about. So I hope you found value in the video. I hope it was useful. I hope it gave you the information you needed. And if it did, be sure to hit like, hit share, and hit the subscribe button. And until next time, stay safe.